Thanks for joining us for the Executive Series. Today I'm speaking with Russel Pillemer, who is the CEO of Pengana Capital. And we're talking about private equity. Russell, great to talk to you.
Thank you for having me, Tom.
Now, when we talk about the difference between public and private markets, we kind of forget a little bit about the massive amount of investment that goes on where private equity is concerned. How big do you think the private equity market is globally?
Well, actually, as an indication of this, if you looked at all companies in the US and Europe with revenues in excess of $50 million, so real companies, the percentage of those companies that are listed is only 6%. So effectively, if you're only investing in listed companies, then you're ignoring 94% of the opportunities in the market. So most action in the market is actually private. In terms of the private equity universe, that's grown in leaps and bounds. About 20 years ago, there was about 600 billion in private equity. Today, that's in excess of 3.5 trillion. So these markets are very large markets.
That is an extraordinary number. And when you consider sophisticated institutional investors, they have a substantial amount of their assets invested in this market. The Future Fund, for example, has got something in excess of 16% invested in private equity. But that's a very difficult area for the average investor to get exposure to.
Yeah, so when we look at a group like the Future Fund, they've obviously got a large amount of their portfolio in private equity, but actually they lag the rest of the world and their peers of the rest of the world.
As far as sovereign wealth
funds, mega rich family offices out of the US and Europe, those numbers are more like 25 to 30%. So there's very large amounts of money that are allocated from those types of investors. Unfortunately for retail or even direct high net worth investors in the Australian marketplace, they don't have an opportunity to invest in private equity, and not the best elements or the best types of private equity. And this is really because the access to private equity is just not there. The supply of top-tier private equity is dwarfed by the demand, and so what you find is those investors who've been there for many years investing with the top private equity funds, they take up all the capacity and nobody else can get a look in.
And the important consideration here is that there's an extraordinary amount of value that is being created in private equity from the early startup phase by the time the organisation gets to the public phase.
Yeah, so the way we think about private equity is really in three forms. You've got your venture capital end of the market, which is the early stage investments. You've got your medium-sized companies, and then you've got your mega-type companies. The area of the marketplace that we're particularly interested in, which we feel has the best risk-return trade-off, is that middle end of the market, the billion-dollar type company rather than the $10 billion type company. But all those companies have lots of cash flows, they're all profitable companies, and they just need capital in order to either grow or change their shareholder base. Really incredible statistic will indicate just the imbalance that's associated with that end of the market, and that is that in the US, the number of listed companies over the last 20 years has fallen by more than 50%. So half the companies, they're only half the companies that there were 20 years ago. And what's happened is that if you're a billion-dollar type company in the US, it's too hard to be listed. You've got to do quarterly reporting, which is a very tough way to run a company. You've got lots of compliance, your legal costs, etc., etc. So those types of companies don't want to be go into the markets anymore, and they've stayed in private hands. And so you find an absolute abundance of those billion-dollar type companies in the offshore markets. Very different to the Australian marketplace, whereby a $1 or $2 billion company are the mainstay of our markets here. Yeah. But over there, it makes more sense for those companies to be unlisted, and that's the end of the market where there's fantastic opportunities to invest. At the same time, the risks associated with those investments are not particularly large.
Indeed. So what sort of a lens do you put over the billion-dollar cohort that you're focusing on? Are there particular industries that you're focusing on? Are there particular areas that you tend to steer towards rather than not?
Yeah, so the companies in general need to be cash flow generating companies with good growth prospects. But In terms of what sectors or geographies, etc., diversification is key, and you want to have as much diversification as possible, provided that they're top-tier type businesses that you're investing in. So make it across industries, across geographies. Now, most of the action is actually in the US market, so you can imagine most of the investments will be there, but there's also some in Europe and to a growing extent in Asia as well.
Now, you're bringing a listed vehicle to the market. Why have you chosen to list this rather than keep it unlisted?
So the problem that investors have with private equity is really the key problems are twofold. Number one is the access to the top tier private equity investments, which we've solved through our joint venture with a group called Grosvenor Capital out of Chicago, who provide us with that access. They're one of the leading investors in private equity globally. But the other problem that investors have is one of liquidity. And so the average private equity fund has a lifespan of 10 to even 15 years. And most investors are very uncomfortable with knowing that their money will not be accessible to them for the next 10 or 15 years. You get locked up in these private equity funds. So when we looked at this problem, we said, how can we solve it? And it was very similar to what happened in the property trust industry many years ago, where property is a very illiquid asset class, but the property industry figured out that they can get liquid access to investors by listing their property trusts. Yep. And so investors can come in and out at the front end, and the fund manager can manage the trust to the best extent possible without having to hold cash or sell properties to fund redemptions. We look exactly the same as a property trust, but our underlying is private equity, which is also a very liquid asset class, and we give access by investors buying and selling at the front end.
And the way you've structured it is that investors get an immediate upside from this structure as well. Tell us a little bit more about that.
Yeah, so this is a very unique structure that we've employed here. What we're doing is an investor who puts $1 into the IPO, when it opens up on day one, he will have an estimated 5% uplift in net asset value. So effectively, on paper, actually making a 5% gain. We're doing this by taking some assets and putting them into the vehicle without any charge to those assets. So in fact, just charging $1 for the full amount of the assets that we're putting in. So if we raise, for every $100 million that we raise, we will take assets of $5 million and put them into the vehicle for $1. The assets that we're putting into the vehicle are shares in our publicly listed funds management company, Pengana Capital Group, PCG. Yep. So we will freshly issue, for every $100 million we raise, $5 million of PCG shares, and we'll put them into the vehicle for $1 for the whole $5 million. So effectively what you'll find is there's a 5% gain in the NAV, estimated gain in the NAV on day one.
So, given that you have a strong commitment to being aligned with investors in the trust, I mean, it seems like a novel thing, but why have you got such a strong commitment from day one?
Yeah, well, that's right. It is a very strong commitment. It will cost us a lot of money, obviously, to do that. In addition to us paying the costs of the offer. So there's also approximately a 3% cost of the offer to pay for the syndicate, etc. So we've got a lot of commitment here. And the reason why we've provided the equity component to investors is, we think it's the right thing to do. We also want to align our investors' interests with our interests. We love the idea of our investors and our shareholders being one and the same. And this has provided us with that platform to accomplish that.
Now, what are the offer details and the important dates, Russell?
Important dates are that the offer closes on the 10th of April. So we encourage investors to speak to their advisors, take a look at the offer documents, and really consider this investment. It is truly unique, and it's got some fantastic attributes in terms of its risk and return prospects, and make a lot of impact in a portfolio sense.
Indeed. It's been great talking to you. Thanks for your time.
Thank you, Tom.
And thanks for joining us for the Executive Series.